Hello, fellow traders. 'Tis I, TheRumpledOne, coming to you Sunday, January the 8th, the year's 2023. Let's talk trading. It's time for the weekly open and gap. These videos are for educational purposes only. Your results may differ from mine. And just a quick reminder here, we're starting out a new year. Risk management. Always have your risk management in place. Never lose more on any single trade than you're willing to lose on a single trade. So let's take a quick look at the weekly. As we can see, all the gaps have filled. And if you notice, the pound opened and just went up. So we haven't hit that weekly pivot. And taking a quick look here, you can see we broke out of the opening range for the month, and we're setting the opening range for the week. And you can see here January, where we're putting in yearly high and yearly low. And you can see on this chart, inside bar, from 5 days ago, we broke out. And the inside bar from 2 weeks ago, we broke out. 92 pips range so far, and we're 8.5 hours, a little over 8.5 hours into the trading day. And you can see that gap down here, and it filled. And right now we're happening to be in the launch pad. You can see here we hit the buy zone, have not looked back. And right now we're in the rat zone. Hit a high at 21.63, almost 64, and it's pulled off 20 pips. Would have been a really nice short if you would have turned around. And we can see the H4, the current H4 starting to turn red. Pivot trading plan. Open above the pivot point, so near pivot, the bias is long. Near R1, the bias is short. And I believe R1 is right here, 2182. Okay, 2175 is this month's pivot. And we hit 21,639, so we've missed that monthly pivot by 12 pips so far. The weekly, we opened above, missed by 60 pips. And the daily, we've missed by 61 pips. So we've got some open pivots if you're playing the pivot. In and out of that upper wick zone. Weekly range, once again, right now, only 92. Last week, we had 261 at the 33 percentile. Looks like this week could possibly be a big one. And looking at the Walmart lines, you can see this hour we crossed the 50. Went up to, once again, 63.9, so it paid off to the upside. We'll have to see if there's going to be a payoff to the downside in the last 19 minutes here. We haven't even gotten close. Well, 4 pips away. I guess that's close. We put in a 3-ball. We went through the lowest high there at 44. Ran up a couple of pips. Now it's coming back down. And year-to-date accumulated range 307 so far. And so the year-to-date accumulated and the monthly range will be the same in the month of January, obviously, right? And looking here at the trade reminder, trying to see inside the upper wick zone on the monthly. Wow, 4 months in a row positive. Fade the weekly pivot sell. And we got H4 turning red here, coming down to that 40. Let's see what happens there. It just cracked the 40, so Walmall trade would have triggered. And I don't really see anything else really interesting here. Once again, this is just a trade reminder. So you just, when these things come up, these are just things that it reminds you where price is compared to certain levels. Because it's real easy to get caught up and get tunnel vision. It's like playing chess. Sometimes you only look at the squares in the middle. You forget about what's going along those outer edges. And all of a sudden, a bishop or a rook can come down and start, taking away a piece because you didn't see it because you weren't looking. So there's many, many things to look at. And sometimes there's information overload. You get signals. Some say go long, some say go short. And what can happen is, let's say you're trading one method, like the Walmall method, where you're just going to go long or short at the Walmall lines. But then all of a sudden, you take the trade and then you get stopped out. And then you say, oh, well, if I would have only known that was there, yeah, I wouldn't have. And then it happens again. It was something else. Pretty soon you've got a list, maybe this long, of things telling you whether or not you should take a trade, and then basically you get paralyzed. And so what you just have to realize is in fact, I told a trader this today, the method that you use is important, but where you're going to find the most important piece to the puzzle is when you look in the mirror. It's you as the trader, because I've seen people be successful with the buy zone. I've seen people not be successful with the buy zone. I've seen people successful with the 3-level ZZ. I've seen people not be successful with the 3-level ZZ. It's the trader. It's not the method. It's because what'll happen is a trader will start out with one method or one indicator, whether it's RSI or moving average or MACD or money flow indicator. It doesn't matter. It really doesn't. And they wind up losing. So rather than take a look in the mirror, they'll go find another method or indicator. And then somewhere down the road, it's not working. They'll go look for another method or indicator. When the whole time, all they had to do was look in the mirror and say, what am I doing wrong, or what am I failing to do properly? And that's what it boils down to. Because, as we've said it, Walmall says it, I say it. Once you put the trade on, the reason that you entered the trade no longer matters. It doesn't. Walmall was teasing me about, why did I take that one trade when I went long and it went against me? He said he was cringing. But the funny thing is, it worked out for me in the end. Yes, I had to average in. That's just my style. I knew exactly why I took the trade. I didn't really break any of my rules. And maybe the only thing happened was, had I been in a little bit quicker, I could have gotten out where I got in and made a pip or two. That was the only thing. Because one thing I've noticed is trading, it's better to get in like right at the open level of the candle. Not necessarily when the candle opens, but at that open level. Reason being, is price is going to move away from the open. It'll either move in your direction or against it. And sometimes it might only move a few pips in your direction. So if you get in at the open, those few pips can be your profit, especially if you see it move, stop, and start to reverse. Maybe you had a chance to put the stop in, or maybe you can just click the mouse and get out because you don't like the price action. But the main takeaway here is that it's you, the trader. It's your money management skills, your risk management skills, your trade management skills. I mean, because the turtle traders proved it. They taught all these traders at the same time, the same method, gave them the same amount of money to start with, and some made money and some didn't. So it's obviously it's the trader. It's not the teacher, it's not the method. So the thing is, what you have to say is, what are these other traders doing that I'm not? Or what are they not doing that I am? And that's how you learn. And that's how you get better as a trader. Not looking for the, shiny new object, the hottest indicator. And you know what? To be perfectly open, I still look at other forms and I sometimes look at other people's indicators and I'll download them and just take a quick look. And sometimes, like, something to learn here. And most of the time, not interested, especially if it has to do with squiggly lines. If it has to do with horizontal lines or statistics, that's when they catch my interest. In fact, there was one that I was watching where the guy was talking about, I forget what he called it. It was kind of like order blocks, but it was something else. But what I realized after studying it and I looked at it, I go, this guy's just playing wick zones. So it's like, okay, so I really don't need to look at it any further. It's just he was doing something with wick zones, and his statistics were slightly. He was computing something different than the way I was computing it, or what I was computing. It's totally different statistic, and it just made things a little more valid for me. It's like, okay, I see what they're doing, makes some sense. But anyway, point being, yeah, you want to fix your trading, take a look in the mirror and fix what you see. I mean, think about it. You either need to manage your trade better, manage your emotion better, manage your money better, manage your risk better. Those are the things you have to work on. I mean, because once again, you put the trade on, it's going to do what it's going to do. And so those are the things that will make the difference. That's the difference that makes the difference. You. Because if you think about it, everything else is the same. Somebody can give you their everything. They could write it down. They could spell it out in detail. But the question is, do you follow it? Do you follow it to the letter, or do you slightly deviate? Do you try to put your own spin on it? And sometimes that'll work, and sometimes it might not. Sometimes you might need to put your spin on it to make it work for you. But the thing is, you have to be honest with yourself, not say it's the method or the indicator, and just, take a hard look. Now, if the method doesn't really have statistics behind it, and I'm not talking about back testing, I'm talking about real statistics where you calculate frequency distributions and see if you actually have that chance. Because the problem with back testing is it looks like you could have made money, but you may not have gotten the fill. You may not have gotten the entry where you wanted it. So that being said, fellow traders, I hope you had a fun, safe weekend. Hope you have a profitable trading day, week, month, year. And just remember, it's not what you trade, it's how you trade it. So go out there and drain the banks. This is the Rumpled One, over and out.